Hello everyone. This is Fixed Income Outlook for the month of February. We have been pointing out for some time now that policy priorities in India will shift from controlling inflation to supporting growth. In last few months, the inflation projection for coming quarters have started to fall within the range of flexible inflation targeting framework. But the new risk has risen in the form of sharp INR volatility. The expectation of higher terminal rates in US and higher global economic policy uncertainty are putting downward pressures on all emerging market currencies. In the recent past, the FX intervention by central banks suggested a clear intention to control the pace of slide in the currency. However, the last GDP print announced in month of November 24 was a turning point for policymakers. First, in the budget, we saw a fiscal push in the form of tax breaks as it focused on lagging consumption growth. For FI markets, more importantly, it was reassuring to see government's commitment to the fiscal consolidation targets for FY25 and 26, with a forecast of 4.8% and 4.4% of GDP respectively. The net borrowing numbers are also in line with market expectations. Second, we saw RBI easing monetary policy by giving the first rate cut in the last 2 years, even when the global economic policy risk remains high. Going ahead, while it is logical to expect that there will be another 25 basis point rate cut in the month of April, since a single 25 basis point rate cut does not help with the growth in a significant way. The MPC has, however, maintained its neutral stance, which does not lock it into either loosening or tightening the action for the next policy. This must have been because of the evolving external environment, which on one side is negative for the growth, also spur inflation or even cause both, with possibly large trade tariffs being discussed. Going ahead, the fiscal stimulus will always be limited when we are on a fiscal glide path. The stimulus should also come from monetary policy. Till date, food inflation has been keeping headline inflation high. Food inflation has now started to ease, and even RBI's projection for the consumer prices for FY26 is around 4.2%. This creates space for the rate cuts in coming few quarters. For rates, however, this macroeconomic setup means higher G spreads, which is G-Sec minus repo rate, than seen in past, as investors need to build in some margin of safety coming out of Goldilocks scenario, which we have been in past. Secondly, the government securities market will still remain well bid as the expectation of future rate cuts set in, and well balanced demand and supply for government securities act as a mitigating factor. This can still generate capital gains. Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.